Is it possible to find good deals in 2024? Today, we're going to find out with a real live deal sent to me by one of you that I'm going to analyze here in real time. Let's see what happens. Today's deal comes from us from Nihal Osman, a BiggerPockets community member, and he's looking to buy a deal for about 180 grand in Detroit. I already like that a lot. 180 grand is very affordable for a duplex that he's looking to buy. And he said that for a long-term rental, which is just one of the scenarios we're going to look at here, he thinks he can get $2,000 a month. So already this hits the 1% rule, which is very encouraging if we're looking for cash flow. Just a couple of other details before we dive into the deal. Nihal is expecting to put 30 grand into this deal. It's his first deal. He likes the location of the house and he is looking to generate a hefty sum, a hefty cash flow. Okay, 30 to 40 grand in yearly cash flow in the first 2 years. I don't know if we could hit that goal. That would be like something like an 100% cash on cash return. Probably not likely, but let's see if we can get a more realistic cash on cash return when we look at this deal. So I'm going to pop over to the BiggerPockets deal finder and just type in Detroit first, pull up here and see what we got. And then I'm just going to copy and paste the address here. We're going to blur this out so no one steals Nihal's deal. Okay, so first I'm just going to look at the description here. We see that this is, okay, there are long-term tenants in there. Currently renting at $1,200 and $900. So we already not just validated Nihal's assumption of $2,000 a month in long-term rents. We actually, it's higher. It's $2,100 a month. So that's pretty solid. So I'm going to look at these photos here. Kind of hard to tell, but I'm already seeing some damage here above these windows. This little thing going on with the balconies worrying me a little bit. Deck looks nice. Okay. Interior is not bad here. I would choose a different paint color if it were me, but it doesn't look like it's bad shape. They're original hardwood floors, as it said in the description here. I mean, it's not in great shape. I would think that you're going to need to update this stuff, but nothing is super standing out to me yet. Okay, you're starting to see a little bit of cracking here in the ceiling and in the walls. A little bit, you're seeing vertical cracking, never a good sign. These doors are in a bit of disrepair. All right, now we're seeing some water damage if you see on that slanted part of the roof. So I'm already thinking that this property, although it's just 180 grand, is going to need quite a bit of work. This side looks a little bit better shape to me, but the siding probably needs some work. It needs some paint. These floors need refinishing. So I'm already assuming here that Nihal's estimate of 30 grand for rehab here is probably not enough. I'm going to estimate, just not knowing a ton about it, probably something closer to 50 grand, especially if he wants to command those higher rents. I'll also just go down and look at some details here. We see that it's actually on quite a large lot, 0.2 acres, but it's a super old house built in 1911, which just confirms to me that we're going to need to put a lot of money into this thing. So the last thing I'm going to do here before I start running the numbers is to just look at the neighborhood a little bit. And what I see when I look at our forecast, this basically just predicts where we think appreciation is going to come in the next year, that this area near Indian Village is not forecast to grow that much. It might be flat, but it doesn't look like it's actually going to grow. We see areas of Detroit that are actually quite, are appreciating a lot, but they're more of these suburbs. Like if you look here at East Point or Dearborn, that's where it's growing a little bit. The downtown area is not growing as much. I'm also going to check out the crime maps here and see what it looks like here, especially if you're going to do a short or midterm rental. It's not like the worst crime in the city, that Eastern Market area. This work looks a little worse, but it does look like there is some crime. I like to check out the violent crime. Not as bad, so it's mostly property crime. But let's just zoom out a little bit here. Oh, you have to zoom in, sorry. It's not that bad, actually. When you look at most cities, most urban areas are going to be orange, yellow, reddish. And so this is actually not that bad. What does concern me a little bit is about the forecast that's not in an area that's really, forecasted to appreciate. I am going to finish this deal analysis in just a second, but before I do, I got to ask, are you all tired of coverage gaps that come with one-size-fits-all insurance policies? At National Real Estate Insurance Group, every investment property property has a perfect fit. NREIG's program for real estate investors offers fully customizable coverage for all phases of occupancy on one monthly schedule and bill. So break free from the constraints of generic insurance policies. Request a proposal at nreg.com/BPYT. That's NREIG.com/BPYT to get started today. I'm going to run over to the BiggerPockets calculator and start running this numbers here. So I'm going to go here to analyze deals. I'm going to use this calculator. All right, so I'm just going to throw this in. Next, go down to my purchase price, which just as a reminder was $179,000. And I'm going to put in $4,000 for closing costs here. I do think we're going to rehab this place. I think I'm going to put an estimate of $50,000. Obviously, if I was buying this deal, I would spec this out and do a real scope of work, but just gut instinct, $50,000 here, but that will improve the value of the property. I think that would probably get us to maybe $240,000 in this neighborhood, just based on some comps that I looked at before. So for property value growth, I'm going to keep it at 2% because, as I said, I don't think it's going to appreciate much more than average, and 2% is actually lower than average. And so I'm going to keep it at that for now. Next, for our loan details, Nihal said that he was going to do 7.7%, which is way higher than the average right now. So I'll take him at face value, but then we might rerun this deal with 6.9%, which is about where things are right now. And then I'm going to do a 30-year fixed rate term. For monthly income, let's just plug it in at what is the existing rent, which we know is $2,100 from the listing. Then I'm going to go back to figure out what our taxes was because Nihal told us. For taxes, we had $4,000. He combined taxes and insurance to $4,000. So I'm just going to put $2,000 for each here. And then repairs and maintenance, let's see what he put in here. He said he needs some feedback to accurately assess. So I'll tell you, this house is going to need a lot of repairs, but I'm putting $50,000 into it. So after that, I think that we're going to have just like normal repairs and CapEx, because with that $50,000, I'm expecting we're going to have to do new electrical, probably do a new HVAC system. We might need a new roof, new paneling, like a lot of stuff needs to go into that. And so I'm expecting lower repairs and maintenance going forward because we're going to put a lot of that expense up front. I'm also going to put in 5% for vacancy and 8% for property management fees. And then we're going to assume that our tenants are going to pay the utilities for this, because usually that's what happens with a duplex. So let's just do this. Let's see if this thing works. Okay. Wow. This is actually an interesting cash flowing deal. So even though I jacked up Nihal's estimation from 30,000 in rehabs to 50,000, we're still looking at $264 a month for a 3.5% cash on cash return. Now, I said earlier that 7.7% loan that Nihal was getting seems too high for me. I'm actually just going to pull it up for you guys. If we look at these mortgage rates today, you see the average is 702. So I don't know if he got this quote a couple months ago, but I'm going to go in and just change this down to 7 in case he got, the average mortgage rate. I don't know why you would pay more than that unless you have really bad credit. That actually jacks it up to 4.5%, which is not bad cash flow depending on the area. For me, I would consider something a 4, 5, 6% cash flow if it was a place that was appreciating well, but this doesn't necessarily seem like it, or at least I don't know enough. So I would need to buy this property so that it generated more cash flow if it was going to be worth it to me. And the way that I would look at doing that is either offering less, because this thing's going to need a lot of work. And so maybe we can get it for 165. Now we're looking a little better, 5.6%. Let's go see how long this has been on. So it's been on the market for 28 days. So they might be willing to accept a lower offer, but this is still a little thin for me, given the risk of the neighborhood. And so what I would look at is, because I'm improving this property and I'm going to be doing so much work for it, can I get that rent up? Because people are paying $2,100 right now for current condition. But if you make that property a lot nicer, you might be able to generate higher rents. And so what I'm going to do here is actually go over here to our rent estimator on BiggerPockets, and I'm going to put in our address here because I want to see what sort of the higher end properties in this area get. Let's just look for the one that's 2-bed, 1-bath here. What I see here is that the median is about 1,000. So that's kind of what we're getting right now. But if you make something a little bit nicer and you get to that like 75th percentile, it looks like you can get 1,150. Again, if I was buying this deal, I would look at this more carefully, but let's just assume I can get this to 2,200 or maybe even 2,300 because I'm going to make this a lot nicer. Now this starts to look like an attractive deal, right? 8% cash on cash return is really solid. It's better than most other investments you can make right now. And because you're improving the value, you're getting an annualized return of 13%. Just for reference, stock market index funds typically average 8 or 9%. And so you're doing a lot better than that. Now, of course, I don't know if you could buy it for 165, but to me, once I make some of these adjustments, this starts to take the shape of a deal that I would be interested in. So I would, if I was Nihal, I would check to make sure my interest rate, because if I can get it for 7 or even 6.9%, because that's what rates are looking at right now, then you're looking at a good cash on cash return. I would double check with property managers in the area what I can get for rent on a renovated property, a nice renovated property, because I'm putting 50 grand into a $180,000 property. That's going to significantly improve the quality. What am I going to get in rent for that? And then last thing I'd see, since it's been sitting on the market for 28 days, if I can offer lower. But I think all in all, there's enough in this deal that I would consider making an offer on it, not as is, but given some of these adjustments I'd made to the assumptions, I think it could be worth exploring more if you feel confident in this neighborhood and your ability to manage a property in this neighborhood. What do you guys think about this deal? I would love to know if you think this is too thin or it's the kind of deal that excites you, because there's so much room for value add, and some interesting things are happening in Detroit that might help raise the value of this property. Probably not in the next year, but maybe over the long term. So let me know what you think in the comments below. Thank you guys so much for watching this episode. If you want me to review your deals, don't forget to fill out the form in the show notes and description below. Thanks again. I'll see you next time.